Hello there, Marty Pomeroy, CEO and Managing Director of Smartpay, here today to present up our most recent financial year results for financial year 23. Presentation today will cover off, as I said, the most recent financial results for our FY23 financial year with a March year end. As I said, I'm Marty Pomeroy, CEO and Managing Director of Smartpay. We've got a relatively simple run sheet to take you through. Firstly, I'll give an overview of our business across Australia and New Zealand in the payments space. We'll then cover off the key outcomes for the FY23 year, including more detail on our results, an update on our focus on sustainability at Smartpay, and then an outlook for financial year 24 and beyond. So who are we? How are we? And what do we do? Our strategic goal as an organisation is to be recognised as the most reliable, capable, agile and innovative omni-channel payments provider in Australia and New Zealand. The New Zealand market we serve has about 120 to 140,000 payment devices installed across businesses throughout the country, and we have about a 20 to 30% share of that market. The Australian market has about 1 million devices installed across the country. We've identified our addressable opportunity at close to 250,000 of those businesses, and we currently have about a 6.5% penetration, but growing rapidly. In the most recent financial years, you'll see shortly, we just about doubled our base size and penetration into that market. Our vision is to be the payments partner of choice. We execute into both markets with a combination of our own IP and productization, and with partnerships with scale providers of network services and processing services to ensure we grow rapidly and efficiently as we access our opportunity. We have approximately 100 people working out of our New Zealand offices and about 60 working out of our Australian offices. We operate on a one team, one organisation basis. So we leverage talent wherever it is located and deploy it and apply it where the opportunity presents itself. We are an in-office employer. We do not operate on a hybrid employee arrangement. We prefer to have our teams working collectively together. It assists us with our agility and building out an outstanding culture within our organisation. We purpose our people around clear objectives and goals on an annual basis and longer term, and that empowers our people, whether they're a frontline staff member all the way through to the executive, on our ultimate execution plans and the delivery of our performance. And we deliver to all stakeholders. We are listed on the Australian Stock Exchange and the New Zealand Stock Exchange. So we have shareholders, internal employees, and other partners to the business. And our focus is on delivering to all stakeholders. The products we have in both markets are slightly different. In the New Zealand market to date, we have simply supplied a payment device on a lease contract to merchants, whereby the revenue is reflected in a simple flat monthly amount that we get each month as a contracted revenue for the lease of the equipment. Into our Australian opportunity, we are providing a full in-store payment solution, including the acquiring or settling of the card payments for the day to the merchant overnight. For that solution, we charge a percentage of the merchant's volume, and that is reflected as a revenue in our P&L. That is the revenue and the opportunity that we've been rapidly growing into over the last sort of 4 or 5 years, with obviously the most recent year reflecting our most rapid growth. We have 2 products we take to that market opportunity. One is called a simple flat rate product, whereby the merchant pays a flat percentage no matter which card is presented, and they pay that as a cost of their business. We have another solution called Smart Charge, where the customer adds a small percentage onto the cost of their goods and passes it on each transaction to the card holder. That is the solution that we are disrupting the Australian market with. The market at the moment in Australia is dominated by the banks. they prefer not to have that type of solution in market. And so when we provide it to merchants, we offer a real cost saving for them in their cost of payments. And we're having tremendous success with that solution in that market. I'll now talk to FY23, and as we reflect on it, the first thing I would say is that it has been somewhat of a breakthrough year for our business. We have always had strong top-line revenue growth, but we have a significant amount of discipline in our business, focused on delivering strong operating leverage and profitability. We believe in sound unit economics and sound business fundamentals and discipline and execution. And 2023, or financial year 23, has shown and reflected that in strong business metrics across the board. And I'll take you through some of those now. We've continued with our strong revenue growth, largely off the back of our Australian business, which I'll talk to a bit more in a minute, but reflected in 62% year-on-year growth, so 77.8 million, up from 48.1 million in the prior year. As I mentioned just before, we are very focused on delivering strong EBITDA or operating leverage. And you can see that that's up 81% year on year from 10.2 million in FY22 to 18.4 million in the most recent year. The EBITDA that we generate and the leverage that we generate drops down to the bottom line, and possibly the most impressive metric this year is the profit, which is up 328% year on year to 7.6 million. We generate our own operating cash to fund our growth, and that's up to 18.6 million from the prior year of 11.8. Whilst we've accelerated our growth in FY23, we've maintained the ability to generate operating cash flow and fund that growth even at an accelerated level. With our free cash that we've generated, we've continued to repay our debt. Whilst our debt leverage is very low, we've continued to repay our debt out of our free cash. And you can see free cash is up as well year on year. And we find ourselves in a net cash position in terms of cash over debt. So a very strong financial year for the organisation in what have been challenging economic times. And I believe it reflects the discipline and focus and execution capability we have as an organisation. We have some fundamentals that we've talked to in this most recent financial year that shed a bit more light on our operating leverage and control. As we've grown, you can see that our operating cost to revenue is an improving metric and highlights that we have good OPEX control and P&L control, as I say, as our revenues have lifted. Our headcount per revenue is improving also, which is a very important metric that highlights that as we scale, we're not just putting bums in seats to support that. We're leveraging technology and focused on building an efficient business as we continue to rapidly scale. The transacting terminal fleet in Australia has grown from 9,800 odd terminals to, say, 15,700 terminals. Those terminals are the driver of our revenue. So the significant uplift in transacting terminals feeds into the significant uplift in revenue. And we've always looked at our terminal fleets across Australia and New Zealand as a network. And part of what I'll talk to later in the presentation is our ambition to take our Australian solution into the New Zealand fleet. So as a network of terminals, we have over 46,000 across Australia and New Zealand and rapidly growing. This slide, I think, highlights the story over the last 5 years, and I think is a good collation of the key metrics associated to our business. Our rapid revenue growth has been telegraphed fairly early on and can be seen on the very left sort of graph from FY19 throughout. Our operating leverage has become most obvious in the last couple of years and is really starting to show yield from our revenue and highlights the OPEX control we have. And you can see that when you look at our OPEX to revenue ratio. As can be seen, profit before tax has been positive for the last couple of years and is starting to grow. Net debt to net cash is obviously, and what is also obvious is our generation of free cash flow from our operations. So these, I think, metrics, the sort of the last 3 or 4 metrics I've mentioned have obviously shown out quite considerably in FY23. but they follow through from the revenue and operating leverage improvement that we've seen over prior years. As I mentioned previously, the Australian business is the high growth opportunity for us at the moment. You can see the revenue effect of almost doubling our acquiring transactional revenue year on year, driven from the transacting terminal increase that we've seen, but also a focus on higher revenue businesses as part of our sales and marketing targeting. We have actually settled to merchants over $5 billion of total transaction value in the most recent financial year, again, almost double the prior financial year. And that highlights that we're an increasingly scaling or an increasingly larger participant in the Australasian cards payments market. Our average revenue per terminal of circa $4,800 per annum is a very impressive result, and is largely due to the way that we have structured our payment solution to allow merchants to pass on the cost of acceptance in each transaction to the cardholder. We are an annuity revenue business. So once we have onboarded a customer, we continue to receive revenue from them on a monthly basis. So an important number always is what our run rate is at the end of the year. And as you can see, our monthly acquiring run rate revenue in March year end was 6.2 million. That presents a very good foundation revenue for us for growth in the next financial year. We're also an organisation that focuses very heavily on customer experience and ensuring that we're building a loyal, supportive customer base as we grow. The importance of that is obviously to when we look to add more value to the customer's business and deliver more revenue value for us over time through the introduction of, say, new products, etc. Having a high net promoter score ensures that you have a loyal base of customers who are ready to receive further solutions and further offers from you. Our New Zealand business is the business that we've had for the longest. As I said, 20 to 30% market share in New Zealand. It's a stable business, and we've focused on maintaining that business, both to leverage the operating capability to support our growth into Australia, but also to present the opportunity to give the business option value around leveraging our Australian solution back into New Zealand and quite dramatically changing our revenue outcome. As you can see, revenues of close to $14.5 million on an annual basis, average revenue per terminal of $450 odd per annum. So about 10% of our revenue realisation from our Australian installed terminal. And so the opportunity for us has been focused on converting that New Zealand fleet to reflect more of the Australian revenue experience. And we are focused on that strategically. We have close to more than 31,000 terminals in market in New Zealand, so approximately twice the size of our Australian base, and that further reflects the strategic opportunity we have to leverage that and convert it into the Australian revenue model. And a strong net promoter score in New Zealand as well. The key difference between the net promoter score in Australia versus New Zealand is the ability in Australia to add even more value through acquiring services to our customers. So we would expect that net promoter score in New Zealand to be more reflective of our Australian result when we're able to deliver that solution. We'll just breeze through these next slides for now. We talked about key dates for the next financial year. Obviously, this is a roadshow to our most recent roadshow to our investors. So we obviously have our AGM on the 27th of July this year. Our financial year is a March end, so we put our half-year results out late November this year, and then obviously our full-year audited results will go out 27th of May next year. Just to touch on sustainability, at Smartpay, we're very focused on sustainability. We accept and acknowledge that as our business is rapidly growing, and we scale up for all stakeholders, including the markets, there is more focus on sustainability and our businesses and our organisation's approach to sustainability. We have a walk the talk attitude to sustainability at Smartpay, letting our actions speak louder than our words, I guess. and we are focused on the impact we have and the positive impact we have, not only on our people, but also on our communities and, of course, the environment. We're mindful that in New Zealand, for the New Zealand Stock Exchange, compliance is changing to require more reporting around climate impact, and so we are preparing the organisation on that front, and we would expect that will follow on the Australian Stock Exchange as we continue to grow. So whilst we already make great efforts in ensuring the minimum environmental impact through a focus on recycling of old equipment and hybrid vehicles, whilst we only have a small fleet, ensuring they're hybrid vehicles, we're also cognizant around terminal packaging, etc. There is more work to be done as we continue to stay abreast of the ongoing compliance obligations. We also are aware that our customers and businesses that we deal with are very active in their communities. We're dealing with small to medium enterprises, and so are we. So we are a local employer, and as we grow, we get the opportunity to employ more local people. We're also a living wage employer, so rather than pay minimum wage, we subscribe to giving people the opportunity to earn a reasonable living. So we are a living wage employer across both Australia and New Zealand. And rather than just having a social club or a social committee within the organisation made up of a team of our people, we actually have a wellbeing committee, and they are focused on broadly the wellbeing of all of our people across both our Australian and New Zealand business. All of these opportunities to make a difference, where we take a significant amount of pride in, are premised on our ability to build a sustainable business with good fundamentals. And so we have an absolute resolve to continue to do that and build strategic value for our shareholders. Whilst we've had an outstanding FY23, I believe that the key opportunity for us and the most excitement is to be found from a look forward. And so as we look forward into FY24 and beyond, I believe we have some clear objectives and some clear opportunities. Our philosophy has always been to deliver outcome and not sell dreams. So we would rather be clear and concise and transparent on our objectives and then be held to account for our execution. So with regards to the business, we are very much focused on our continued acceleration into our Australian opportunity. As I say, we're only sort of 6.5% into the market potential we have. We would expect to continue to accelerate into that. We are building a next generation Android in-store terminal solution for both the Australian and New Zealand market. And our organisation has a team of over 25 engineers. We build and will sort of design, build and deploy our own software applications. It's retained as our IP and supports our point of difference into both markets. We'll continue to build out our one team, one organisation focus, ensuring that we maximise the leverage opportunity we have from the potential we have in our teams and deploy it in either country as it is required. This will ensure we stay lean and focused and agile. We will also continue to stay, abreast and ahead where we can of the sustainability and other, elements in our organisation that you would expect of a business that's maturing rapidly. So we have good, strong risk and compliance governance and those sorts of things. So we'll make sure that we maintain in step with those expectations as we grow rapidly. I guess the final piece is that we're very focused on preparing for our New Zealand opportunity. In a recent update, I talked to the market about the fact that we had committed the organisation to delivering our Australian solution in effect to our New Zealand terminal fleet, which is a very exciting and transformational opportunity for our business. And we are now preparing to do that. To talk a little bit more about that, and just to give some insight on the effect that it may have for our business, or will have for our business. In Australia, we have a complete solution of not only the terminal in-store, but also processing and settlement of funds to merchants, and those are reflected in terminal rental plus transactional revenue in our P&L. In New Zealand to date, we've only been able to provide the terminal, and so it's a lesser revenue yield. What we're looking to do is, through our partnership with our Australian processing partner, we will deploy a terminal into our New Zealand fleet, which will also be able to provide for transactional processing and therefore transactional revenue realisation. It's a significant, provides a potential for a significant uplift in revenue for the business, and significant improvement in obviously GP. And given we already have a full stack business in New Zealand supporting that terminal fleet, we expect that we'll be able to leverage a lot of the Australian capacity and materials to execute that opportunity and that conversion. So should be very significant also, we would expect, for our operating leverage as we go forward. We're in the early stages of this execution, but we are fully committed as an organisation to executing it and realising the opportunity for our business. Thank you for the opportunity to present this information.